Despite a series of major foreign policy actions between January 2025 and January 2026, tariffs, military strikes, and geopolitical confrontations, the stock market remained far more stable than history would normally suggest. This is not about politics. It's about how markets translated risk during an unusually consequential period. For educational purposes only, not financial advice. Welcome to Epic Money Mindset, the place where ambitious people come to master money, build wealth, and create real, lasting financial freedom. Let's start with something important. This is not a political endorsement, and it's not a political critique. Trump is central to this discussion for one reason only: the foreign policy actions occurred under his leadership, and markets were forced to evaluate those actions in real time. What's interesting is not whether those actions were right or wrong. What's interesting is how the market translated them. And by historical standards, that translation was unusually calm. Here's the thesis. Given the scale, frequency, and visibility of the foreign policy actions taken under Trump, markets would normally have reacted far more violently than they did. In almost any other modern period, sweeping tariffs, direct military strikes, regime-level interventions, and open confrontation with major geopolitical adversaries would have triggered sharp sell-offs, sustained volatility, and prolonged risk-off behavior. That didn't happen. Not to the extent history would suggest. And that divergence is worth studying. Historically, markets hate uncertainty. They don't dislike it. They don't tolerate it. They punish it. Looking back at major geopolitical shocks since World War II, U.S. equity markets typically experience immediate drawdowns of roughly 1 to 3% following major conflict events, with volatility remaining elevated for weeks. After 9/11, the S&P 500 fell about 12% in 4 trading days. During the 1973 oil embargo, U.S. stocks lost over 40% peak to trough. During the Gulf War, oil prices nearly doubled while equities sold off sharply. That's the historical baseline. Now fast forward. Under Trump, the U.S. implemented sweeping tariffs that, at their peak, covered more than $300 billion of imported goods and touched over half of U.S. trade flows. When those tariffs were announced, the market reacted exactly as expected. The S&P 500 fell nearly 5%. The Dow dropped more than 1,200 points. Roughly $2 to $3 trillion in market value disappeared in days. That part was normal. What followed was not. Markets stabilized quickly. Volatility faded. And within months, major indices recovered and moved higher. That rebound wasn't optimism. It was calculation. Markets weren't saying, "We like tariffs." They were saying, "We can model this. Tariffs are measurable." Corporations adjust guidance. Supply chains reroute. Margins compress, then reprice. Once uncertainty became structured, fear evaporated. Markets don't panic over risks they can spreadsheet. Now consider military action. Direct U.S. strikes on Iranian nuclear facilities, combined with retaliation threats, represented one of the most serious confrontations with Iran in decades. Historically, Middle East escalations pushed oil prices up 10 to 30% within days. This time, oil briefly spiked around 4%, then retraced. The S&P 500 dipped less than 1% during peak tension and recovered almost immediately. Why? Because global energy markets are structurally different. The U.S. produces over 12 million barrels of oil per day. OPEC maintains spare capacity. Strategic petroleum reserves exist. Markets translated the event as a geopolitical shock, not an energy crisis. The same logic applied to Venezuela. The removal of a sitting leader in a country with the world's largest proven oil reserves would historically rattle energy markets. But Venezuela's production had already collapsed from over 3 million barrels per day to under 800,000. The supply risk was already priced in. Markets shrugged. Even broader escalation didn't break the pattern. During periods of heightened Middle East tension, the VIX briefly moved into the low 20s, well below crisis levels seen during COVID or the global financial crisis, when volatility surged above 60. Markets noticed, but they didn't panic. Now here's where the interpretation becomes more nuanced. Markets don't just price actions. They price reactions to actions. And during this period, what stood out wasn't only what the United States did, it was what other major powers did not do. Historically, major foreign policy moves trigger immediate counterthreats. Retaliatory tariffs. Escalatory military responses. Diplomatic brinkmanship that feeds uncertainty. That pattern was muted. This is not a political judgment. It's a market observation. Markets may have interpreted the global response, or lack of response, as a form of deterrence. Not deterrence as praise. Deterrence as perception. Perception of unpredictability. Perception of decisiveness. Perception that escalation paths were harder to model. Markets care deeply about second-order effects. They care less about the first move and far more about the chain reaction. In this case, the chain reaction was limited. Trade partners adjusted rather than escalated. Military responses remained contained or symbolic. Major powers avoided direct confrontation. From a market perspective, that matters. Contained reactions reduce tail risk. Reduced tail risk suppresses volatility. Lower volatility stabilizes equity pricing. Markets weren't saying, "This is good." They were saying, "This is bounded." Bounded risk is tradable. Unbounded risk is not. There are structural reasons this translation happens faster today. Passive investing accounts for nearly half of U.S. equity ownership. Algorithmic strategies dominate daily trading volume. Liquidity is deeper and faster. Fear doesn't cascade the way it used to. Instead of panic selling, markets rotate. Energy adjusts. Defense reallocates. Tech pauses. Capital keeps moving. There's also a psychological shift. Since 2008, markets have internalized one assumption: when systemic risk appears, policymakers intervene. That expectation compresses tail risk pricing. But this calm isn't free. Tariffs raise costs gradually. Trade fragmentation reduces long-term efficiency. Persistent geopolitical tension raises capital costs. These forces don't crash markets overnight. They erode returns slowly. The danger isn't a sudden collapse. It's a slow repricing that feels normal, until it doesn't. And that brings us back to the core insight. In almost any other historical period, the foreign policy actions taken under Trump would have shaken markets far more than they did. The actions were significant. The response was restrained. Not because markets approved, but because markets translated the risk as manageable. Markets no longer react emotionally to power moves. They react mathematically. What once caused a tsunami now produces ripples, until something proves those ripples deserve to become waves. Thank you for watching Epic Money Mindset. If this brought value to your life, stay connected and pass the insight forward. I'm grateful to have you here, and I'll see you in the next video.